I'm Betty Solonik, CEO and founder of Accelerate Investors. Welcome to our podcast, Chief Investment Officer Conversations, which brings to you what is on top of mind for the world's leading CIOs. In our conversations, we will explore their background, their current investment strategies, and their global outlook. In this episode, I interview Chris Ailman, the CIO of CalSTRS, a $230 billion pension fund which has a 72% female membership. In this episode, he discusses their risk mitigating strategies and innovative strategies and the role they play in the CalSTRS portfolio. He discusses how we are in a health crisis versus a financial crisis and where he sees investment opportunities. He also shares with us his thoughts on the CalSTRS Emerging Managers strategy. I hope you enjoy. Hi, Chris. How are you? Thank you so much for being here today.
My pleasure. These are certainly unusual circumstances, and I'm glad we're able to make this work.
Thank you. I really appreciate it. You're the CIO of CalSTRS, which has an investment staff of 170, and you oversee a portfolio valued at about $227 billion as of March 31st, the second largest pension fund in the U.S. How has COVID-19 crisis impacted the way you invest and do business?
You know, it has been amazing, first on the staff side, how quickly we were able to shift to 100% remote. We had been debating remote access for individuals and how could we work that within an investment office because we're so used to a trade desk. We manage half the assets of CalSTRS in-house, so over $110 billion on our trading desks. And within less than 4 days, we had to make the decision from an A and a B trade team to everybody external, and it worked. And credit our technology team for being a government entity. They worked really quick to give us remote access. Now, that said, we've been at it now for about 7 weeks. It has strengths. It has weaknesses. People are tired of working at home. I've got a lot of staff in that 170 that have young children. One of the suggestions today was to get a stronger lock for the door for their office. A lot of people didn't have a home office, naturally, so they're sitting at kitchen tables. So a lot of frustration with chairs, lighting, number of screens on a monitor. It's not fun to work on a laptop constantly. And then I think just the challenge of interaction. We're all doing tons of Zoom meetings, but a Zoom meeting with a flat surface is a lot different, frankly, than seeing somebody face to face. So interesting challenges. I think that we've made the adjustment. It's going to be harder to figure out how to come back in, back to the home office. We're going to probably have to stage that in. And then suddenly, it was easy being 100% in the office, now being 100% remote. What's it going to be when you're probably 50-50? And we don't have any prior experience in this. So that's going to be an interesting challenge.
Thank you for sharing that. Before diving further, I would like to step back for a bit. I would love to hear about your background. Where are you from, your career history, and also what drew you to CalSTRS?
Well, unconventional path, which is not unusual for a lot of people. Grew up down in the Southern California area. Originally, I'm a Valley boy, so I am from the San Fernando Valley. Really thought I wanted to be in aviation or oceanography, but discovered Wall Street very late in my college career and found it utterly fascinating. So I'm so old. Back when I was taking computer classes, they were with punch cards and a big mainframe. So the IBM PC was just coming out when I graduated, and information technology really drew me in. Even though I had studied to be an accountant and had a business economics degree, I really was fascinated with Wall Street and investment banking, and so started there. In Southern California, worked for 2 different Wall Street firms now, neither of which exist anymore, but spent about 7 years working in Wall Street firms, and really enjoyed more the institutional side and the long-term planning. So I earned my certified financial planning certificate back then, and worked with quite a few hospital corporations and retirement accounts. And when an opportunity came up in government, I thought, well, I'm not a government person, but I'll give it probably about 5 years. I was at that point where I could use a stable income, and things were rocky enough on Wall Street. So I went into government and found surprisingly that it fit my lifestyle and fit me well. And I'm amazed, but I stayed. So I got the opportunity to run a worked for a county treasurer, issue a lot of municipal bonds, ran a 401k plan and a 457 plan. And then I also was the investment officer for the retirement plan. It's rather funny. They didn't call us chief investment officers back at the time. They were only senior investment officers. This is all the way back in the mid-'80s. But really enjoyed working on retirement planning and for retirement plans. So stayed in that for a long time. Got the chance to go up and run the pension plans at the state of Washington, which is truly fascinating because they run over 26 different trust funds lumped into basically 5 asset allocation categories. But as well known by a lot of people, a big leader in private equity. And early in private equity, big part of their portfolio. So very enjoyable. Inherited a great team up there. It's amazing to see Gary Brubaker and what he's done in the past 19 years, and just a hats off to him and his retirement. What drew me to CalSTRS, I'm from California. We said we'd only come back for two jobs in California, CalPERS or CalSTRS, and amazingly, they both opened the CIO job at the same time in the year 2000. CalPERS was going through some upheaval and changes, so I decided not to compete, pulled out, and ran for the CalSTRS position. We were very happy in Washington, but the size of the fund, the fact that this board gave discretion to the staff on money managers, on lots of transactions, was very appealing to me. And then lastly, family connection. My sister was a retired teacher. I have a sister-in-law who's an active teacher. So it just kind of fit within the culture. I've always had an affinity for CalSTRS. And now I've been here. This is my 19th year. I'll hit 20 years in October.
Thank you. Well, it's certainly an important pension in our nation. Teachers are very important for our future generation. So thank you for the work that you do. I'd like to get into what it's like to invest as CalSTRS, and especially what it's been like investing during the COVID-19 crisis. I'm curious, have you made any changes, or do you anticipate making changes to your asset allocation because of the market downturn caused by COVID-19?
At 230 billion, CalSTRS is a big, giant portfolio. It doesn't spin on a dime. I used to always use the analogy that we were like a large cruise ship, and the board would pick a dot on the horizon, and our job was to aim to it. The difference is we never came into port. Now, given COVID-19, I may need to pick a different vessel than a cruise ship because that has other connotations. But, it's the fact that we have a 30-year horizon, a perpetual 30-year horizon. So we truly are long-term. We don't go into port. So we can't stop this boat on a dime. We can't spin it on a dime. It's such a big portfolio. That said, we can batten down the decks and cancel the entertainment and really lock down the ship in a rough storm. I'm very proud of our team because we have a tactical asset allocation team that meets on a regular basis, and we always meet monthly, but boy, starting in late February, we started meeting not just weekly, but even daily. And then we hit March, we were talking 3 times a day at the opening, midday, and at the close. So we made the portfolio much more defensive. We went into this at the early part of February, fairly neutral to our asset allocation, but then very quickly moved to being very defensive on global equity, overweighted fixed income, overweighted an asset class we call risk mitigating strategies, which is new to people. And then by March went extremely defensive. Big cash position. We learned that in 2008 and 2001 is that in this kind of a crisis, you really frankly need to hoard your cash, have all the liquidity you can. We're staying in that defensive position. This rebound in the market is quite surprising to all of us. Frankly, the market sort of defies logic in here. We're having record numbers of unemployment. We're having companies report 70% drops in revenue, yet the market is basically where it was in December. That's just illogical to me. But so we are really now in a balance of still slightly defensive, but we are beginning to look for opportunities and to get a little offensive as we see stay-at-home or shelter-in-place orders lifted on people.
Speaking of being defensive, you have an asset class called risk mitigating strategies, and it's expected to help the total fund achieve its return objective by protecting capital during equity downturns or volatile periods. And it's about 9% of your portfolio. Tell us more about this asset class and how has it performed during the COVID-19 crisis?
I think there's going to be a lot of focus on this type of asset class and others. There are only a handful of pension plans in the country that have a specific risk mitigating strategy or a crisis risk offset asset class. Some of the Canadian plans have similar diversifying strategies. They just don't lump it together. But in essence, this was born out of 2008, where correlations, they're not stationary. And in 2008, correlations quickly went to 1 in almost every asset category, private, publics, non-U.S., U.S., everything. And so it really caused us to keep searching for what are things that will be somewhat of a diversifying category to global equity. Our portfolio we have to earn 7%, so no surprise, we're tilted to growth assets, but we want to see diversification. We recognize there are very few investments that are negatively correlated. There are just some that have lower correlations, and recognizing those correlations shift. So we have built this asset class up. The board has faith in it and moved it to 9%, soon to be 10% of our asset allocation. It's comprised of 4 different strategies that as we studied recessions, and sorry to give a long-winded answer, but it's a complex asset class. We studied recessions. There's no past recession that bears resemblance to another. And so if you think about it, insurance, there's no perfect insurance coverage for recessions. So we built up a bunch of different strategies that react to different types of recessions. That said, to answer your question, this performed well, where obviously in March, almost all equity portfolios had a very negative return. This had a slight positive return. So it was not correlated to global equities. It performed as we had hoped. The difference was this March recession was more rapid than anyone had ever seen in our lifetimes, more rapid than the 1930s, 2930s. And the percentage moves each day in March was just staggering. To have the market move 10%, 12% up or down in a day was so unique. So it was very difficult to find anything that would perform well in that type of an environment. But we think this portfolio would. We're not out of the woods yet because we're in a recession. Even though the U.S. equity market has rallied off the bottom at this point, we're still far from a recession. We don't know how people are going to be able to go back to work and where the economy is not going to rebound to where it was in January. So I think some of our longer-term strategies will turn out well and help buffer the portfolio, particularly if we're caught in a narrow trading range within the global equity markets as we stumble out of this crisis.
You also have about $839 million in innovative strategies. What's an example of a strategy that was incubated and graduated that is now or has mitigated the impact of the COVID-19 crisis? And are there any strategies that you are prioritizing right now?
Great question. We're one of the few shops that has an innovation portfolio. One of the blessings of being large, like CalSTRS, we can dedicate a team and a staff to basically become like a 3M laboratory who are tinkering and looking at will different strategies work, particularly at our size. You hear things advertised on TV, and I always like to joke, this team is always figuring out, does it work as it's proposed on TV? The best example of what has graduated is the RMS asset class. Each of the 4 strategies, 3 of them were incubated in this portfolio, realizing they had a common theme of having a low correlation to global equity. We lumped them together and it became its own asset class. Right now, the primary focus of the innovation team is to try and find things that diversify the plan and improve the return. I like to call that the golden goose. Very few things exist that would do that we haven't already discovered. But the next is if they can find things that reduce our return or enhance our return in some way that doesn't amplify our risk or reduce our risk. And so they're still experimenting with different things. Things like low volatility equity are easy, and those are graduated as well. But looking at different things like leasing, assets that don't have a natural home in a traditional asset allocation, they can review them, actually test drive them. And that's the difference. You might have a Wall Street banker come and tell you how wonderful something is, back testing, but we need to test drive it at our size and see if we can really scale it and move the needle. And frankly, there have been some of the best work they've done, our strategies we've chosen not to graduate because we just realized it wasn't scalable. The fees were too great. It wasn't as advertised.
Thank you for that background. I'd now like to ask you about private equity. How active have your private equity partners been in deploying the dry powder during this current period, and what type of opportunities are you seeing?
You probably have read lots of people who say private equity doesn't want to waste a bear market. And I think they feel that way. The difference is this bear market's caused by a health crisis. We are still seeing, during the fact that the economy is shut down, we are seeing the initial need is more on the credit side. People needing debt to help bridge this block of the economy, this time period in place. So not a lot of drawdowns yet. I think there's sort of a mental anchor for most companies of what their price was back in February, and it's hard for them to readjust to where it is now. It's only down 15% from where it was in February, according to the public markets. And you have to realize February was all-time highs. So I think it's going to be slow. I don't think you will see transactions, but it's going to take a lot of time. The first transactions are certainly on the debt side, as I said, bridge loans and senior secured loans at the largest companies. Unfortunately, in this crisis, I think the biggest pain is going to be felt by the smaller, mid-cap, small-cap. So the mega buyouts may be more challenged, but I think regional buyout firms, growth equity firms are going to find lots of opportunities of entrepreneurs that were not able to bridge the crisis. And then there'll be chances for them to buy and build up on a regional basis. The question will be pricing. If pricing doesn't adjust lower, you're paying EBITDA multiples, remember, in January and February that were all-time historic highs. And you're assuming a perfect economy. Well, as soon as we come out of this, you're going to have an election. And who knows what's going to happen. You're still going to have questions with the trade with China. And you're going to have all the issues about Brexit. People have all forgotten about that. It seems that UK has been able to leave okay. What does that portend for Southern Europe and Northern Europe? So I think when we get on the other side of this, the globe still has lots of challenges. Oil obviously has just cratered and will destroy parts of that industry. So we'll see transactions, but I actually think they'll be a bit slow. I don't think it'll be a rush to the gates to get money out. We want them to be patient and pay attention to price.
You've said that this is a health crisis and not a financial crisis. With that in mind, I'm sure many investment managers have been reaching out to investors like you with a myriad of investment opportunities created by the crisis. Which, if any, have you or your team found interesting? What advice or caution would you offer to others in your seat regarding all these new investment offerings?
I think paramount, my advice to others is you need to have a team that can take a look. Capital is important. This isn't a liquidity crisis like it was in '08. It's a bit different, but still, putting your capital out, you really want to have a comprehensive view of it. At CalSTRS, we've actually created a portfolio risk team that of all the private asset classes and the publics to make sure we're looking at opportunities equally across the platform, because our capital is scarce. We don't want to just or take a risk and earn 8% here when we could take a risk and earn 18% somewhere else. The difference, I think, between 2008 and now is I don't think the opportunities are going to be as great. Many of the things we looked at in '08, '09 produced 20, 25% returns. I think this is going to be much lower, high single or double-digit returns maybe. And it certainly is already starting to become more of a debt-focused crisis, not equity. People were leveraged, not overly leveraged, but high leverage going into this. A lot of borrowing with rates being so low. And they're going to violate what covenants they had, and they're going to need financing. And so the initial opportunities we're seeing is certainly distressed financing, where you can get a good loan with senior secured or potentially equity warrants, but those are still going to be mid-double-digit returns. And I think that the number of new funds that are coming in, people realize that you really want to be with tried and true people that have been in this space before, probably haven't been very active for the last couple of years in a bull market, but now are seeing the opportunities come their way. As a new fund starting out, it's hard because you have to have connections and a track record. More than ever, this is going to be about due diligence. doing your homework, making sure a manager really understands their credits and their risk, with the inability to travel and actually go visit and see people and kick the tires. It's really going to be about a firm's ability to tap into their network. And some of the initial investments we've seen are actually ones where the company has known the firm for over a decade. And so it's not hard for them to do their homework. But it's going to be an interesting challenge. We are seeing a lot, but people can't travel. So it's a matter of looking through your portfolio and then figuring out where the opportunities really are. Not surprising, most of the opportunities are coming at very high fees. And that also is a concern to me because that just eats into your returns, especially if this is not as a high return opportunity as 2008-9 was. Fees matter.
Great. I now like to focus on small and emerging managers. What is CalSTR's emerging manager strategy? Do you invest in first-time funds?
We do invest in first-time funds, whether that's private equity, real estate, less so in infrastructure because that market just is kind of frozen. There aren't a lot of first-time funds right now there that we've seen. But we are very much open to first-time funds. We have a program in each of the asset classes. They vary based on the characteristics of the asset class. So in private equity, we have 3 fund-of-funds managers, regional with different focuses between buyouts, growth equity, venture. In real estate, it's obviously location. So we have a lot of emerging managers, but they're property-specific or location-specific. Same thing in global equity. We're finding the U.S. is just too highly efficient. So we're going more and more passive in the USA, but we are using active strategies in non-U.S. and looking at smaller managers there as an opportunity. Fixed income's 80% internally managed. We do have some emerging managers, but very little amount of the portfolio is external. Please come talk to us. We have built long-term emerging manager programs. We've been at this since 2003. We have a 5-year business plan on emerging managers and how to increase the diversity. And what we really want to do this time is move away from the term emerging manager because all that means is it's a small manager or new manager. What the board really frankly cares about is diversity. And that's where what we're trying to do, working with the CFA Institute and their work on diversity and inclusion, is frankly really adopt a definition of diversity. What does it mean to be a diverse manager? Doesn't just mean a small private firm owned by one person who's diverse. We have to address the fact that we want diversity in larger firms as well. And then what does it mean for us as an internal manager, but what does it mean for external? Doesn't mean we're not going to look at first-time funds. We'll keep looking at first-time funds, but we want to recognize there are some pretty good diverse firms that now are mid-sized to large, and we want to look at that comprehensively across the portfolio. We're also going to go out and hire an individual in our staff, a diversity person strictly voted to being the face for us in the industry. We've heard back from affinity groups over and over again that a common single point of contact is really helpful for small managers. And we want to create that. So in this difficult environment, we're actually open and recruiting that and now trying to probably find a search firm to help us because it's so hard to hold interviews and get a job opportunity out there in this environment. But I think by this summer, you'll see us. The biggest challenge we're going to have, and I think everybody does, is how do you measure inclusion? It's one thing to look and see diversity, and we've been very clear in California, diversity is beyond just visually what you can see about a person. It's really more about what the inside of the person, their background, their story. And so we're going to have a broad definition of what diversity is, but we also really want to figure out how do we measure inclusion. It's one thing, as you've heard, to be invited to the dance. It's another to get the chance to dance. We have seen money managers come to us and show us the diversity of their team. Are those people included in the decision process? Is there truly inclusion in a firm? And how do we as an investor measure that?
I'm curious, that person that you're hiring, how will they be integrated with the investment staff?
It's going to be an investment officer position. We're placing it as an associate portfolio manager right away. They're going to report directly to Scott Chan, my deputy CIO, but importantly, they're going to report to a senior diversity steering committee. Obviously, if you get the chance to look at me, I'm the opposite of diversity. People have heard me complain about pale, male, and stale. With Zoom, I have to see myself and I realize, gee, I'm the pale, male, and stale. So I put together a senior diversity team that is a steering team led by June Kim, our director of global equity, but several senior people in the staff. This position is going to report directly into that group so that it has access just not to the deputy CIO and myself, but to the directors of our various asset classes. We have a diversity team within STIRS. We've had that actually in place since 2005. That's made up of a variety of staff, really a good growth opportunity for staff. But it's more in the logistics of gathering data and putting together a report on a regular basis. I want those both integrated so that the teams are sharing information, we're sharing best practices, working with the CFA Institute to also push the industry.
Got it. And I'm curious, out of your current portfolio, what percentage or number of underrepresented managers do you have?
I didn't highlight that question. I'll get you the report. We have a diversity report that came out last fall, and then another one's going to be coming out. I think we just had a conference call on it, so they're putting it together. Part of the challenge of measuring the number of managers, we have about 220 external managers, and I'll get you the count on how many of those are considered small, which is emerging, unfortunately. We're having trouble because we don't have a definition. We have a challenge of how do you define a diversity firm in a large manager. The other thing is that over half the portfolio is passively invested. So the number of active managers has frankly been shrinking on a regular basis as we concentrate our portfolio and we really push back on fees. So with half internal and a big chunk of it passive, there's just less active management opportunity for all types of managers.
And you also talked about making sure that people or managers or diverse people are feeling included. I'm curious, how do you hold your managers accountable regarding their diversity, and not just underrepresented managers, but also maybe your large managers that you can say are the breeding ground for future talent of underrepresented managers starting their own firm? How do you hold them accountable that this is something that they value and that they hire and train and retain diverse talent, and also that they're in the leadership positions?
Yeah, no, you're raising an excellent point, which is for diverse talent, the opportunity set is not just small new managers that might be owned by somebody diverse. It's got to be the large majority firms, the BlackRocks, the State Streets, the AllianceBernsteins, the Goldman Sachs, the Morgan Stanleys. They got to be able to start careers in all those places because I want those firms to be diverse as well. Right now, we're only able to measure it by how the firms define diversity. That's why we want to put out a definition so that we can measure ourselves, but then also ask the managers to measure. If you look at the CFA Institute's work on diversity, that is their number one recommendation is to develop a definition. Some firms had very good ones, other firms had very vague ones, but it is asking your managers either use our definition or yours, but to get the data. We're investment people. What is measured gets managed. And until we measure it, then we're not going to have good information and we're not going to be able to hold managers accountable. The goal for us with diversity is not just to be nice and do a nice social thing. Frankly, our goal is to reduce our risk. We believe that diversity is a key tool to breaking groupthink. If you have all the people that all went to similar universities in the East Coast and have similar backgrounds, they're going to think and act alike. But if you have diversity, you're going to be challenged and somebody's going to raise the question, should we actually be going to that much leverage, or shouldn't we be going to this market, or maybe we shouldn't be going to this particular market? We want to see people break groupthink and show that they have a diversity of all kinds of aspects. And that's why we're trying to expand the definition of diversity away from just physical appearance to more about background and the story. But that also, frankly, makes it harder. So we're going to ask our managers. We've been doing the traditional way, but we're going to ask them more along our definition. As I said, I hope we'll adopt our definition coming this summer. Then we get into measuring it. But the next thing is, as you hit on, is the challenge is, okay, that's great. That's your diversity. Where are they in the organization chart? Are they all at the entry level? Are they all on the support team? Or are they all in operations? Or is it actually diverse? And then what's the inclusion? I'm frankly sick and tired of seeing a team come. They know we're a teacher's fund. 72% of our membership is female. Half of my staff is female. And it's not hard for people to figure that out. So a manager will come and visit us. They will come in with 5 men, 1 lady, and that lady's carrying the presentation books and passes them out. And I can tell you that fries my staff. Not just the ladies on my staff, the men too, because we get it. It's like, this is ridiculous. I want to see women, people of color, people with diverse backgrounds, people of diverse age groups in senior positions having an influence. You do not want your venture firm in technology run by a bunch of 60-year-old guys who barely know how to use, like me, Zoom and their iPhone. I think we have to really expand how we think about diversity, and it's hard, but move beyond what it physically looks or see what we see with our eyes, and realize that diversity is richer and deeper. And we know in life that most things in life are built better if they are with a richer, deeper fabric, and you make better decisions in that process. You've heard me joke many times that, would 2008 have been different if instead of Lehman Brothers, it might have been Lehman Sisters, or better yet, Lehman Family. The Harvard Business School, when I was there once, had a art exhibit of Lehman Brothers, and I was just awestruck. Not by the fact that, yes, they were all white male. They were all the same age. And it's just the realization of, like, good grief, they managed that firm for almost 150 years. But then they destroyed it. And we're a long-term investor. We want to be at this for 200, 300 years. We need people who can make good decisions and think more broadly and not just follow a herd over a cliff.
Thank you for that. One thing I would add is that I wouldn't shy away from keeping racial diversity. Last year at the Accelerate Investors Annual Conference, we had Professor Kathy Phillips from Columbia Business School present, and she wrote a paper called How Diversity Makes Us Smarter in the Scientific American. And she did a study where physical appearance matters, because they did a study where a group of people who looked different acted differently because of the other people that looked different from them. So it still matters. So I would say that's very important. There's different levels of diversity, how you look, how you think, your background. It's really great to hear how proactive you are being about finding that definition and measuring it.
Absolutely agree with what you're saying. And I think that's probably, 75, 80% of diversity is physical appearance, gender first, then ethnicity. But it's still going to come down to things like education, background, sexual orientation. Out here in the West Coast, people often lump Pacific Islanders into just one massive group, and it's the recognition that, those are very different cultures, very different backgrounds. So, and we're seeing that certainly with the Latino population. Big difference between the word Latino and Hispanic and Spanish speaking. So I think it's that issue of it's got to be deeper and richer, not just a glance at a picture of what a picture might tell you, but there's a deeper fabric there, and we've got to. It's harder to measure, but I think we owe it to the world to take that extra step.
Great, thank you. Thank you for listening to part 1 of my interview with Chris Ailman. Please stay tuned for part 2. I'm Betty Salonique, founder and CEO of Accelerate Investors, and you've been listening to CIO Conversations. You can follow Accelerate Investors on LinkedIn, Twitter, and Instagram. If you haven't yet, go to Apple Podcasts and subscribe, rate, and review this podcast. Thank you for listening.